Welcome to MacroEdge Radio. Please note that the content aired on this program is intended strictly for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. The opinions, discussions, and views expressed by our contributors, guests, and associated MacroEdge staff are their own and do not necessarily represent the official stance, strategy, or opinions of the MacroEdge organization or any of its affiliates. While we strive to provide accurate and up-to-date information, MacroEdge Radio makes no representation or warranties of any kind expressed or implied about the completeness, accuracy, reliability, suitability, or availability of the content of this show. Any reliance you place on such information is therefore strictly at your own risk. We do not endorse or assume responsibility for the accuracy or reliability of any information offered by third-party websites linked through the show or any website or feature linked in any banner or other advertising. We will not be a party to or in any way be responsible for monitoring any transaction between you and any third-party providers of products or services. All audio content of MacroEdge Radio is the intellectual property of the MacroEdge organization, and any use, reproduction, or redistribution of this content without the express written consent of the MacroEdge organization is strictly prohibited. All rights reserved. Good afternoon, everyone, and welcome to MacroEdge Radio, edition number 16, What's Left in July But Blue Sky. Today we're going to be doing something a little bit different from our format. The guests we will have on today are all part of the MacroEdge Team. I repeat, the MacroEdge Team. We're going to sit there and invite you, the listeners, to join us to give us regional reports. All you have to do is request to speak. We want to hear from you. 6, Kalani Kinney Capital, Mr. Awesome's going to join us. We have a full slate of things to discuss. I'm going to start with a little history because that is my specialty, of course. And as you know, I tend to rant about history. It is something that is my favorite subject. And from history, what can you determine about market activity? Well, everyone will tell you it's different this time. Yes, if you crash your airplane in a Ford Trimotor in 1929 versus a Boeing 737 MAX in 2024, there's no difference, though. You're dead. Well, the market is on course to repeating history in a very dark, dank, and sad way. And I'm going to warn everyone right now from my opinion. We're tracing out patterns, behavior, and insanity unseen in American history since 1929. Let's start with the most important part of this. I'm going to read some quotes. I hope everyone's hearing me okay, because this is really insane. There's a Federal Reserve chairman named Benjamin Strong. He was the president of the New York Fed. And in 1927, he administered the coup de whiskey, or shot of whiskey. You know, things were looking bad. There was speculation. And the determination was that, well, the speculation wasn't so severe it would crash the system, so what we're going to do is cut rates. And, of course, we saw what happened from 1927 to 1929. In 23, I should say, Federal Reserve Chairman Jay Powell basically said, I don't think we need to raise rates anymore. Inflation looks okie dokie. And the markets took off like scalded dogs. The speculation is as excessive, if not more so, than it was in 1928, 29, shall I continue? And right into the crash of that year. Same thing is applying right now to the 0 DTE, that's 0 days to expiration options players who have taken over the market. What is going on there? Well, the theory is that we have the technology, mathematicians, quants, as we all love to refer to them in the Big Short, and other individuals that can sit there and program our way out of this. Everything's going to be fine. And as CrowdStrike demonstrated last week, programming our way out of this is no problem. We can never have a crash again because in 1987, well, we had portfolio insurance. In 2008, we had a derivative smorgasbord, which prevented any kind of crash. Everything was going to be fine. Don't worry. We were told right up until Lehman went Tango uniform, that's tipped up for you guys who don't know what that means, that everything was okay, even though the Fannie Mae and Freddie Mac were in conservatorship. We lost IndyMac, Countrywide, blah, blah, blah. Anybody with a brain in 2006 could read Wachovie's books and realize they were doomed. Anybody with a brain in 2006 could read IndyMac's books and know they were doomed. Anybody with a brain in 2024 could read New York Community Bank's books and realize they're effing doomed. And there's a lot more of these companies. If you start reading the financial reports, skip over the press releases, skip over the flashy PowerPoint graphics, and start looking at the hard numbers, a.k.a. the green bar, as us old farts used to call it. And you realize there's something lurking in the background that we're not talking about. We keep hearing about this great consumer, this wonderful consumer we've been talking about, on and on and on. Did anybody read Whirlpool's earnings report? It was an abject disaster. Well, most people say, well, Whirlpool's only a small part of the economy. Whirlpool is an indication of the housing market because you don't exactly buy a house with no appliances, and you don't exactly maintain the crappy modern-day appliances in the replacement cycle by not buying new ones. If they're telling us there's problems in sales and profitability and they're going to have to make cuts, that's a hint. In the marine industry, no one's buying toys. Polaris, Brunswick, marine banks, all those people who sit there and finance the boats, the toys, the jet skis, motorcycles, four-wheel drives, 4x4s, off-road toys. They're telling us sales are down. The middle class is done. The lower class can barely afford groceries. And we're being told by the bald-headed, bull-throwing wonder of Wall Street that, by God, we're in a new bull market because of AI. Guys, girls, pay attention to what's happening. I'm not saying we're going to repeat 1929 or 1987 or 2008, but we have a crisis. We have a crisis of propaganda. Today's market, closing numbers, Dow up 654. That's all the sheep will hear. NASDAQ up 176. S&P up 59. Russell 2000 up 3748. I actually talked to somebody who says, I don't care about the hard numbers, I care about the percentages. Thankfully, I was able to sit there and leave work, go get a haircut, and head to my local watering hole to sit there and digest what that person said. I look at percentages. I don't look at the quality of the holdings in my account. I don't look at what's happening to my account, except every hour almost. I don't really care as long as the percentages are showing a gain at the end of the day. This individual was one of the AI freaks. He believed all the media propaganda. He believed all the bubble vision propaganda. And now he's lost of a 14% gain that he had heading into July. He's lost almost all of it. Welcome to reality. And what's going to happen in August and September should terrify the hell of anybody who's long in this market. The volume today, despite this massive rally of everybody wanting to get back in and support artificial intelligence and Silicon Valley, and we got to have semis in our portfolio, and everything is wonderful, was abjectly pathetic. In fact, if you look at the volume, this is the 4 o'clock volume. It will update some more, but it won't be too much of a variance. From the Wall Street Journal's data markets page, publicly accessible. I try to use public sources. I don't want to quote a Bloomberg. I don't want to quote some of the other services. I want everybody to have a chance to go and look at it. 2.8 billion shares on the NYSE, 4.6 billion shares on the NASDAQ as of 4:09 p.m. Eastern Time. Boys and girls, that ain't going to cut it. That's not a bull market move. And if you look at the chart, you look at the intraday moves, and you look at the sell-offs that occurred through the day, just like yours truly started talking about the markets earlier this week, this has been a week of distribution where the big money, not Uncle Joe and Aunt Jane, are saying, you know, maybe we should lighten up our positions. These are millions and millions of share blocks being liquidated on orders because they anticipate a problem. A week ago, the S&P 500 had a high of 56.69 intraday. Today, it's at 54.59, and morons like the bald fool and all the other idiots in the bubble visions are saying, hey, everything's okay. The Fed's going to bail us out next week, and we'll get that shot of whiskey. Would I be surprised if we got a cut next week? No. Do I expect a rate cut next week? No. September will be the panic cut. And panic cuts in the Fed funds rate heading into an election during a time of financial turmoil are usually results of absolute disaster for the markets. People don't want to hear that. People don't want to hear the bad news. People don't want to look at the candles. They don't want to look at the technicals. They don't want to look at that. They just want to see that quote-unquote percentage. On a quick side note, before I bring my friend Six in here to sit there and calm me down and take my rant off, oil down for the day. Natural gas, the Widowmaker, is continuing to kill people. Gold up $32 in a reflex bounce. Silver up 9 cents. Copper still can't catch a bid because China decided to not participate in the global economy anymore. And the main thing that I can take from all that is gold is in backwardization. If you don't know what it means, look it up. And if you do know what it means you're a long-time listener to my shows back from the 08-07 period. You pay attention, you know what's going on. Gold is your indicator as people are buying it and putting it away in other countries, looking at our country saying, what the hell is going on over there? If you're a domestic United States resident, I'm going to tell you something right now. You might want to stash some under the mattress, under the floorboard, in a mayonnaise jar and bury in the backyard. Do something to sit there and have a hedge, because the education of our citizens is so pathetic. As many of you on FinTwit know, I'm a big-time poster on there. I get warnings all the time for some of the snarky things I say. But a poster said, U.S. Congress can tomorrow decide to redeem all U.S. Treasuries. The day after, you'll have all the money in your account. This is the kind of mentality and stupidity we're facing, folks. These are the people who believe the inflation numbers. These are the people who say homes are still affordable for the lower and middle class. These are the people who believe the bubble visions. And with that being said, Six, are you ready to rock and roll, sir?
Yes, I am.
Bring it, because I've been ranting for a while, and I need a drink.
Yeah, I'd like one too. This is a pretty fun week. I had some good trades this week. It was a good time. But first of all, I think your friend who's talking about percentages, I wouldn't really disagree with him there, because, I mean, all I want to see is the P&L always going up. Now, is he going to, if he held on to his tech stocks as they fell pretty largely this week, then that would be a different story. But, yeah, I mean, I always want the P&L to be going up, and that is the most of the thing that I focus on. But
I'm going to interrupt you real quick. You didn't understand something that I told, which is the oldest saying on Wall Street. Bulls make money, bears make money, pigs get slaughtered. He believed in the buy and hold strategy and a fluctuating market and changing economy. And he actually thought that if he held on to the stocks through the hard times, he would make it all back in the long run. Well, if we remember what happened last time, it took 15 years.
Yeah, with the tech stocks, I'm not sure that these AI earnings are going to materialize. I really highly doubt it. So he might be waiting for a while. I don't think the forward outlook for that is going to be anywhere near as good as it is. The one thing I really looked at this week was Google reported good earnings, and they were still down like 4% the next day. I mean, they beat the expectations, but I think a beat of expectations is already baked in to the current price. Like, I think that they are, everyone else in the market, regardless of what the analysts say they're projecting for EPS, like, I think they expect a substantial beat, the market does, in order to keep justifying these valuations. And the main thing I'm looking for is that I'm not really expecting any earnings misses from the really big tech companies, but I do think that we wrote about this week, but I do think that any modest earnings beats from these big tech companies are not going to be rewarded favorably. I think they want huge blowout numbers to keep pushing the price higher, and I'm not sure that we're going to see that, but I don't know.
Are you ready for this? Google, we were talking about Alphabet, which was one of his holdings, did the usual distribution pattern at 10 a.m. this morning. Somebody sold a massive quantity of shares right on the money at 10 a.m., right when the price, and I'm playing chart time now, boys and girls, sorry if you can't play along with us, at about $169.90 a share. And they sold probably close to 1 million shares at once. This is not Bob and Jane selling their 401k. This is somebody who knows how to play the game, and you know this more than I do. When you start seeing distribution patterns like this, and on a day when the NASDAQ was up 1%, Google was down 48 cents a share. That's alarming. Oh, and I just lost him. Doggone it. Okay, hopefully he'll get back in here. He's in between cells. Okay, I didn't know you're there.
I'm here.
I thought it dropped on me. But when you see distribution, as we've seen for the last 14 days, is that not alarming from a long-term technical perspective as to where this market could be going?
I mean, for sure, these companies are all very ripe for enormous growth going forward. Not 10% for the end of the year.
Okay, folks, I'm sorry. Six has gone Martian, so I'm going to wait till he comes back into a better cell. He must be using AT&T, and his data feed has been hacked. I apologize for that. But the reality is this. When you see massive distribution, as we've seen this week, every rally being sold into, every aspect of the rallies being hit. You back there, Six? You got a better sell? Still going. He is still Martian. Sorry about that, Six. I'm going to mute you for a minute, Six. Come on back in a few minutes when you get to a better cell. I understand how that is. We are looking at a problem here, folks. When I talk about distribution, and I saw someone who is a quote-unquote big-time FinTwit talk about recognizing distribution finally. The drinking game is this week. If you hear the words rotation, small cap, small business, or my favorite one is change in sentiment. Take one drink each for that, but every time you hear rotation, take another one, and you will be passed out by the time the market gets to noon and their usual nonsensical shows, pumping and dumping stocks everywhere. The problem with this, folks, as I see it, is that the new generation hasn't been around for some severe corrections enough to understand what's going on. And this is where I'm going to see if Kalani is available, because he has experience in this. And he's one of our MacroEdge team who understands what's happening when rotation, quote unquote, happens, when crashes occur, when mistakes are made. And we're on the fringe right now of a major mistake. Kalani, would you like to provide some input on that?
Hey, can everyone hear me?
You sound fantastic, sir. And you don't sound like a Martian. I feel bad for Six because he had a lot to add, and unfortunately that hit with him going through a bad spell. Go ahead, sir.
I'll share some of my observations the last week. First, if you're not following Melody Wright from a real estate perspective, I suggest you do, because the new and existing home sales that came out this week, the numbers weren't just bad, they were pretty atrocious. And she breaks down a lot of data that isn't easily accessible from other sources. So it's just really interesting to me. Everyone's heard the phrase, the housing is the economy. I think that definitely is one of the main drivers. So that's a huge concern from my perspective. And then when you talk about earnings. Six was highlighting some of the earnings things that he was observing this week. Earnings revenues are actually down across the board, and I can share a chart in a minute that displays that. Earnings per share are about where they should be, but that's the number that's more easily manipulated or massaged. Actual revenues are a much harder number to manipulate, and that's the real tell of how companies are doing. From a macro perspective, some of the things that I've seen that cause concern include durable goods. The numbers were pretty horrible this past week. And, if, John, if you want to jump in, those are just...
I'm going to throw something to you that's a Florida number, just to give you an idea, because I see you were talking about how Hawaii is starting to recover. Well, Florida, we're starting to deteriorate. 21% of all purchase agreements in several major markets in our state were withdrawn. When you start hearing those kind of numbers, there's a degree of disaster building. And I don't think people understand the financial implications. And you and Six are the two I'm going to turn to for this, because there was a very interesting post. A lot of people don't follow, and don't take this wrong, everybody. A lot of us are geeks. It's just a fact of life, okay? And we follow people like Michael Green, a.k.a. Professor Plum. And there was a great posting today which actually caught my attention, and I think everybody needs to know this. And that is, what happens when Vanguard is forced to sell? Well, they're not good at it. Financial Times highlighted this. And I want to know what happens when these closed funds. Here's the headline from Financial Times. Vanguard warns investors over company stake limits. Asset manager says U.S. regulators could enforce ownership caps, raising costs for index tracking funds. Now, if the ETFs are artificially pumping up the markets, along with the zero DTE options players, and Vanguard's forced to sell and withdraw from that market, Vanguard is a lot larger than these little 20-something-year-old kids playing on Robinhood. Kalani and Six, please take over.
I didn't see that, but I did not see that, but that's a major implication. I think Vanguard manages either $6 or $8 trillion of mostly retirement assets. So if they actually cap out the ownership stakes that they can take in these companies, that'll be massive selling. But yeah, I mean, I have to look more into that. I haven't seen that article.
I also haven't really dug into that article too much, so I'm not going to comment on that. But John, you mentioned something earlier about you were talking about real estate and what I'm seeing. So in Hawaii, real estate is usually lagging in time versus other geographic locations. So I'm starting to see some houses stay on the market for longer. I'm starting to see price reductions, especially more expensive homes, which kind of applies to all homes in Hawaii because the median price is well over $1 million. But so those things are concerning. But, the number one driver of the economy in Hawaii and where I'm from, Maui, by far is tourism. And I shared with the MacroEdge group, I think a week ago, some specific tourism numbers. And across the board for the whole state, they're down. And for Maui, having to do probably to a certain extent with the fires in Lahaina almost a year ago, but the Maui numbers are worse in the state. And that's even before adjusting for inflation. So, the economy is slow. Some of that has to do with pricing. Hawaii is more expensive vacation option than other places, and people are being more price conscious and price sensitive in their spending, and you see that across the board. So, just wanted to add that in response to some of the comments you mentioned, John.
No problem. I'm going to read one sentence before I turn this over to Six for a minute, and from the article, because this should, if you're a sane investor, and I do repeat, sane, your antenna will go up. Quote, the world's second largest asset manager with $9.3 trillion assets as of May, recently updated disclosures for dozens of funds to highlight the increased risk that authorities will force it to comply with long-standing but rarely enforced caps on individual bank and utility stock ownership. Vanguard has come under fire along with two other passive investment giants, BlackRock and State Street Global Advisors, for its sheer size and voting record on climate and social issues. Folks, 6, people don't understand. Sometimes the House forces everyone to lose so they can win, correct?
I mean, if this is just applying to banks and utilities, I'm not sure it would have too big of an effect on the indices, which are mostly made up of mega caps, tech. I mean, JP Morgan, Bank of America, they're pretty big. That could have some effects, but if it's not all companies, I don't think it would have too big of an effect, to be honest.
But wouldn't it cause a liquidity squeeze for financing for homes, et cetera, and for capital races for some of these CRE issues that we're seeing?
It could. I'd have to look more into it, to be honest.
I'm throwing this out there only because I see this as a indicator, much like we used to see indicators in 07 and 08. And I'm not comparing this era to that. This is a totally new ballgame. 6, please take over with some technical analysis of the markets, because my take on this is the distribution patterns we're seeing are disturbing.
Oh yeah, that's definitely correct. So all week we pretty much sold for most of the week. Put in a low last night. No, the low was yesterday around like 10:15, and then we almost sold off to that low at the close yesterday, but bounced right above it. And then what I think is interesting is that we rallied all day. So we had a higher low, but then we also had a lower high than yesterday's rally. We're still under 55.10 on ES, which I'm bearish under 55.10. We're still short ES from 55.61 and a quarter. I think it's going to go lower. We still have some long stock positions, so I'm not getting too worked up about the sell yet, but definitely taking advantage to the short side. I think that has more to go.
Kalani, please add to that.
I agree with 6. One of the things I watch closely are semiconductors, and certain semi ETFs are already down 20%, or they were yesterday. Maybe they bounced back a little today. So, but we've seen steep sell-offs in some of these companies, and that's not a good sign. I think, as a couple of you have alluded to earlier, I think AI is it's not profitable other than for a couple of semiconductor companies, and I think that's a lot of hype. I think that there's not a lot of revenue, not a lot of sales behind those, behind a few computer chip companies.
And 6, would you do us a favor? Fill everybody in on how the MacroEdge Vision is doing, because a lot of people don't understand this. MacroEdge.net, folks. Subscribe now for a 2-week free trial of Ozone. MacroEdge.net. Don't miss this. A lot of the discussions we have internally, we try to share with you on the air. 6 can fill you in on what he's been doing.
Yeah, so we've been running a MacroEdge portfolio since April 3rd. Been doing pretty well on that. We track that every week and do position adjustments. For the most part, we publish our position adjustments on Sunday night to be filled at the cash trading open on Monday morning, except for if there's extreme moves in the market in the middle of the week. We try not to sell in the middle of the week so that our subscribers can, basically track what we're doing and then announce it, ex ante instead of ex post. And we're up about 13% since April 3rd. And it's not just because of the long stocks positions. Our biggest gainer right now is actually long 2-year note futures, which anybody who follows us on Ozone and Vision, knows that I love my 2-year futures position. I think it's a fantastic position. I think it'll do well as the Fed cuts, whether these are dovish cuts or hawkish cuts, I think it'll do well. I think it'll do much more. I think it'll perform a lot better if they're hawkish cuts and a lot more cuts get priced into the forward curve. Very, very excited about that. But yeah, we've been making market moves every Sunday night to be executed on Monday morning, and it's been fun, and I look forward to juicing those returns a lot further in the future.
Six, thank you so much for your input today. And by the way, you need to get rid of AT&T. I'm just kidding. I'm kidding.
I actually got Verizon, and they charged me way too much to have this bad of service.
Wow, that is sad. I'm down in Florida, and I have better service with Verizon than I ever imagined because God knows T-Mobile's god-awful. All right, Kalani, bring it up so we can move to the next speaker for MacroEdge. Go ahead, sir.
Just one last point I wanted to make. Pay attention to transports. Some of the earnings and news that we're seeing with transports has been really concerning this week, specifically UPS earnings. The announcement by FedEx today, there are tons of bankruptcies with trucking companies that John, you, and others in the group have shared throughout, I don't know, actually the last couple of months. But my advice to people is really pay attention to transports. They're telling an accurate story of what's going on in the economy.
Very good. Thank you, Kalani. And I'm going to bring Mr. Awesome up. Mr. Awesome, Ulysses Awesome, and Kenny Capital are going to join us from the MacroEdge team. And anybody else who wants to speak and tell us what's going on in their region of the economy, of the country, and the economy locally, please request to speak. We'll try and get you in there before the show's over. Ulysses, how you doing, sir?
I'm doing pretty well. How about yourself?
Other than finally drying off after getting soaked by one of our local 15-block showers, not bad.
That's good. At least you're drying off. It's been a week. It's been a week up here in Minnesota, anyways.
Yeah, I can see that. I'm wondering, 3M had a decent report for the first time in a long time, but is that indicative of a turn?
I wouldn't say a turn. I think there's going to be sectors that do well, but there's going to be other ones that are continuing to struggle. So I wouldn't call that an outlier, or from my perspective.
Well, what do you make? And this is where you and Kenny and everybody else has had a lot of input for the MacroEdge team. What do you make, especially after our interview with Melody last week, of what's going on in commercial real estate this week? We saw that Big Lots has announced the closure of 54 stores in California. We're starting to see more corporate bankruptcies on the retail side. We're starting to see more of the larger office buildings, including a shocking one. For those of you who don't know, Alpharetta, Georgia is one of the premium locations for office space, etc. What do you make of this picture that we're seeing painted right now? Are we heading into the teeth of the storm, or is this just the beginning? And I lost him. Sorry about that, Mr. A. Ulysses, we'll wait for you to come back. Kenny, what is happening in Tennessee? Because Tennessee is the parallel to Florida, let's face it.
Yes, it is, John. It's, I would say Nashville is kind of like Florida 2.0. It certainly seems that way. It's, wow, we are certainly living up to our namesake, that's for sure, especially after the last few weeks, based on a certain someone who kind of went viral. But no, it's kind of more of the same. We've sort of talked about this. At the end of the day, rates go up. Things like net migration slow, household formation slow, and especially if you're just talking, residential real estate, of course that's going to lock up, the housing market. And it's just a process that we're going to have to work through, and it is what it is. I mean, when I bring this up to people, they think it's, maybe I'm seeing what I want to see, at least in my local market, but this is a problem everywhere, and that really should not surprise anybody. They're just not selling because the price is just too dang high. And I don't care what type of property you're looking at, it is what it is. So.
Well, we're seeing something new here, and that is local mom and pop bars and restaurants becoming distressed and starting to fail, including some very long time favorites, for lack of a better term. Is that starting to hit Nashville yet, or are you guys still about 3 to 6 months behind?
You know, I'm glad you brought that up because it absolutely is. And, you know, what kills me is people will come to Nashville and they will hang out at Broadway and they won't venture out. And that's fine. Like, I'm not against that. You know, you can only do so much if you're in town for maybe a few days at most. But you cannot extrapolate, you know, a few blocks of activity to an entire MSA and assume that that's happening everywhere, because it's not. And in fact, if you look at the most recent numbers for Nashville MSA in terms of employment, and this might shock some people, but these are the numbers, okay? Leisure and hospitality is actually negative year over year as of June. So it's slowing. All of this, the rate of change in terms of how it impacts various industries within the MSA is going to be different, but it is slowing. And so, you know, certain consumers are sort of propping things up. I would argue that's a lot of the older folks, retirees and whatnot. But you're just not having the same volume in terms of, you know, really kind of, and I know it sounds cliche, but if you go downtown, like on Broadway, it's just like a lot of bachelorette parties, and they're just not coming here, you know, like they used to. They're just, in my opinion, I think they're tapped out, and I think that you're starting to see it in the employment numbers.
I think you're right, because we're starting to see the same slowdowns, not just in the short-term rentals in Florida, but also in coastal tourism. And I'm a little spoiled. I can book a weekend vacation whenever I need to, if the weather looks acceptable. My concern about Tennessee is that you guys have a problem, much like Florida, where there was a lot of speculation on future growth assumptions. Is that starting to hit reality?
Absolutely. I mean, that's the thing. When you kind of think about where, I guess, supply could come from, I mean, it's the housing stock. You can't just look at, like, what's for sale and just assume that's going to be sort of, you know, your weather bell. It's not going to really tell you where things are going. But if you kind of add in things like net migration, what the households are doing, and then look at new construction and permitting, it's not the greatest setup. Some of these, you know, I think Austin's sort of the cookie cutter example where there was just a lot of overbuilding. That's not the only place. In fact, I would argue if you normalize those numbers, whether it's against like a local population or, you know, the existing housing stock, especially like the core of Nashville looks very similar to, we'll call it Denver County or Travis County, and there are others. But just the difference being with a bit of a lag. And so all of these things sort of happen, you know, on their own time, and it's just going to take a little bit longer for people to kind of realize what's happening. And you're really seeing it, you know, even on not only if you're in the market of, you know, trying to be a homeowner, but just to rent too. I mean, just this past week, I've just been kind of tracking what's for rent on Zillow in Nashville, Davidson County, and that, you know, over a 2-month period, I think it increased like 300%. And, you know, you kind of have to take that with a grain of salt. But that's a huge outlier. And of course it came in the form of apartments, because we know multifamily, I mean, they just, you know, permitted to, you know, the ends of the earth on that front. But when you think of it that way, from just a structural standpoint, from the demographics and everything else, it is what it is. It's slowing. People think about, I would say, Nashville as a stable sort of market altogether because they think about something like, oh, well, healthcare. Healthcare is very stable. Well, from an employment standpoint locally, that's not our entire economy. That's just false. And I could even argue that healthcare is much more cyclical than it used to be. I mean, I could name a handful of just like these, boutique dental services that are concierge, and they exist, across the spectrum. But it is what it is. This is just part of it. It's just, in my opinion, this is a very dragged out cycle.
Well, we're trying to Floridize you guys. You know that. We're trying to make you more like us. We'll send some alligators up there if it will help. Ulysses, are you back?
I'm back.
Fantastic.
Can you hear me okay?
You sound much better now. Thanks, Kenny, for bringing that in. We're trying to get some regional perspectives. Ulysses, continue, please.
Yeah. I think we were on the topic of commercial real estate and closures.
Absolutely. I think that we're seeing a nightmare appear that Melody indicated in the residential side, but a lot of people don't want to acknowledge on the commercial side because multifamily is part of the CRE mix, as you've Long Islanded.
Yeah, definitely. And what we're seeing is a lot of frozen transactions for buying and selling apartments. And there's a lot coming online, obviously, nationwide, more than we've ever had at any one time. Even though the construction for those has declined for a year, we're still at a record amount under construction. But I think what we're seeing in the commercial space is part of people are used to lower rates for borrowing, and it's not allowing them to buy and sell the way that they were. You've got some deals where refinancing on floating rate debt is not conducive to them keeping their assets right now. So we're seeing some of those go back to banks, and that's across the board from every type of commercial. And then you've got a lot of restaurant closures and a lot of retail closures. I believe that we're at a record, at least a 20-year record for closures through the year, but I need to verify that. But part of that, we're seeing that in earnings being compressed and in the reports from large retailers and restaurant operators, and then through layoffs and closing stores is going to be part of their plan to boost their margins. So no, I don't think we're anywhere near over. I think if anything, we're at the early stages.
A lot of people like to do this 2008 comparison. I think it's totally unique this time versus the past. What do you make of the sudden turn down in retailers, which sort of caught me off guard in the last 2 weeks, but there seems to be an acceleration in retail failures and, let's face it, defaults paralleling the restaurants?
Yeah, well, when somebody needs to start being cost conscious, they're going to shift their spending, and they're going to shift from what's more affordable, and if it's family-oriented consumer decisions, they're going to make decisions where they can feed more people with fewer dollars. So you're going to see a lot more of this restaurant phenomena that we're witnessing, where we've got some pretty big brands like Red Lobster filing for bankruptcy. We've got some deals being sold for basically pennies on the dollar. A lot of these were very popular, well-known restaurants. And then, of course, you've got mom-and-pop shops closing left and right as well.
This brings me to the big question for you tonight, Ulysses, because it has been a fascinating trip this week. We're hearing on one side statistics from the government that everything is awesome. Pardon the pun. On the flip, I didn't mean to do that, sorry. It's just that song sticks in my head. But on the flip side, we're seeing real net profitability and sales numbers on the green bar. Yeah, I know, I'm old. That tells you that we are seeing a decline in consumer activity that is finally having an impact on the financial viability of these companies. Is this an indication of potential deflation in the future, especially in the CRE sector?
It's definitely a potential for it. I think that there are multiple factors at play that could bring about some potential deflation, just as there always have been. It's going to depend largely on how bad things get into recession, and it's going to depend on government response. There have been multiple instances during recession over the last 50 years where there have been deflationary pressures, and governments have responded as quickly as they possibly can to continue the expansion of the money supply. But yeah, I mean, if we stop the credit cycle, we stop the money cycle, we stop the inflationary cycle, and the opposite can take place.
Great. I'm gonna sleep good tonight. Thanks, Ulysses.
You're very welcome.
Priscilla, would you like to provide a North Carolina update? Oh, I thought I had him on. I thought I brought him up. We have a wide variety of diverse individuals who work all over the country and contribute to the MacroEdge team. And sometimes these things do not work. I don't think you can hear me. But what we want to do is bring on Axilla. He's from North Carolina, which is also much parallel like Tennessee and Florida, another speculative market. Axilla, are you there, sir?
I'm here, John. Can you hear me?
Yes, sir. Bring us your latest update, because I'm not only hearing about problems at Bank of America, which they're not going to talk about publicly, but problems with the real estate market getting overheated in your neck of the woods. Fill us in, please.
I mean, some of the biggest things I keep seeing is I live just outside of Raleigh and Clayton. So, I mean, the biggest thing that we have here is we've got Novo Nordisk, which they do the Ozempic and Grifols and other kinds of manufacturing and things like that, science, technology. But the biggest thing around here is they just keep, as far as the housing market, they just keep building. I mean, even as you go around and there's just empty houses for sale all around, you go turn a corner. I was going earlier somewhere and they were just getting ready to build a whole new subdivision somewhere, even when there's right down the road just 10, 15 houses already sitting empty. So I'm not sure where they're getting. I mean, there's going to be growth here, but a lot of that growth is going to be, a couple of years away. What the people are going to do, they can't just buy a house and sit here for a couple of years waiting for a job to start. But it's just the sheer amount of, I don't know if the banks are just, they're going to build until the banks stop lending them money, or how long they're going to just continue to build. But I guess they believe in the if you build it, they will come mentality. But it's the same thing, like Mr. Austin was talking about. You have all these, and that's the other thing, there are all the apartments. At least they're not starting to build new apartments, but all the apartments that are coming online, they're not even finished. And it's far and above the amount. It's just the sheer building. When it slows, that's going to be the biggest problem. It's like, where are the people? And the biggest thing I'm seeing more too, as I look on the Zillow, is the people are just taking their homes off the market. People aren't selling them. They just don't like the prices that they're getting. So they're just taking on the market, thinking that they're going to be able to, come after the summer or the spring, somebody else is going to buy it. So we'll see how that all works. But I think a lot of it here is when I tell people, there's a slowdown coming, you hear always the same thing. Well, it didn't happen in 22. It didn't happen in 23. So it can't happen now.
So, I've got to intervene here real quick. What do you make of what's happening in your restaurant, retail, local, small mom and pop industry? Is that seeing any impact on the growth contracting?
I wouldn't say, as far as the restaurants, there's been some closures, but this seems to be a place where people like to go out to eat. But as far as like new businesses, I don't see anybody trying to open up anything new. There's like one place around me, but it took them it took them about 8 months to open up, a lot longer than they said, a lot of delays. And I mean, it's just, I don't see a lot of things closing down, but I don't see anybody jumping to try to get into the business.
That makes sense. That actually makes a lot of sense because I'm going to quote a statistic that was big deal today. 20% of all U.S. homes for sale had a price cut in June. Folks, if it's hitting on a nationwide quote-unquote average, it's far worse on a regionalized basis. We're starting to see this on Southwest Florida markets because that's one of the hottest markets in the country. That's why I'm asking you, Axilla, are you starting to see price cuts or are you starting to see moderation in new building? I'm just curious.
No, there's definitely price cuts going on. And it seems like a lot of what I've seen is it's like somebody tried to buy the house earlier this year and they bought it and they're trying to flip it. And then you're seeing a lot of people having to try to cut back and they're kind of stuck now. A lot of people are stuck. The people that bought in 22 or 23 and they thought that they could just buy it, do a little bit and put it back on the market. And then you have a lot of the homes, there's a lot of them around here that were bought in like 2008, 2009. I don't know if they were old rentals, and then those are starting to come up for sale. So I imagine that's some of the institutional ownership getting out. But there's definitely, there's no doubt there's a lot of price cuts going, and that's for pretty much, anything around here above $500,000, I wouldn't say as much because then those people know what kind of house they want. But below $400,000, I think that's where you're seeing the price cuts, and any new construction is getting a price cut, pretty much every month.
This sounds a lot like what we're dealing with in Florida, except we're way ahead of you because we have over-speculated and overbuilt to a point where it's beyond belief. My next question for you is more related to what is happening as far as business, because we saw this week that Pfizer is shutting down the Sanford plant. I've been there. That's shocking. However, outsourcing overseas is something that Pfizer is famous for. I went to their plant in Puerto Rico. I've been to some of the other facilities. Is this a problem that the growth hawks in your region have not taken into account?
Well, I think, at the cost of doing business. Now, I think Pfizer, they didn't get something renewed, and then they ended up having to get the plant closed, if I'm not mistaken. But they just in general, it's expensive to keep all the same people employed. I mean, you look at all the businesses that are moving jobs to Mexico and overseas. They just realize that it's cheaper, and then we're losing jobs because of it. But part of it is, I don't know, the biggest thing I see is there's no innovation. We're just trying to kind of recreate the same thing over and over with the same people. And it's like that's not going to work moving forward, just it's the same thing, doing the same thing over and over, expecting a different outcome.
Absolutely fantastic. Thank you so much for your contribution. So I'm going to make a couple plugs here for everybody because last week's show was one of the better shows we've done with Melody Wright, and she gave us a good primer on this, and Axilla sort of walked into my concerns on this. If you're starting to see plant shutdowns and phasing out of regional distribution and manufacturing facilities, it means that those jobs are going overseas, but the people who work at those facilities cannot afford to make their housing payments, their car payments, their car insurance payments, their homeowners insurance payments, etc. Start doing the math. It has an effect that multiplies over and over and over again. And what you're seeing on Wall Street is not parallel to the reality of the economy. I actually read one of the quote-unquote FinTwit bull boomers saying, well, Wall Street is always the most predictive factor for economic activity. Now, I see Rudy's in the house. I see Weimar's in the house. I'll say it point blank, and they'll probably agree with me. When you hear this kind of speculative BS hitting the airwaves, hitting the internet, you start to get concerned. It's not reality. Wall Street didn't predict 1987. Wall Street didn't predict 1981. Wall Street did not predict 1929. And it damn sure didn't predict 08 or December of 2018. It was a disaster. A disaster that was unequivocally caused by people looking forward into fantasy land and not paying attention to what's going on. This weekend, Adam Taggart, who has a fantastic channel on YouTube, is hosting Melody Wright. She does a fantastic job of breaking down what's going on in housing on a regional and local basis. She's kind enough to come on here every several months and provide data and information. Also, she is on the Doomer News Network. She's kind enough to sit there and talk about MacroEdge, promote this group here that we have, and also Travis, Melody, and Jack are also promoting reality. I'm not going to sit there and say we're in competition. We're not. What we're trying to do is bring news that the mainstream financial media refuses to provide. That's the purpose of MacroEdge.net. If you folks want some reality, that's what you need. The diverse opinions we present in our writings, in our Vision Fund, as Six has done an excellent job with, as Mr. Ulysses Awesome has done, presenting broad economic data points that are not viewed by the mainstream. Don Johnson, our chief economist, who is sitting there taking, hey, look at the employment data. It's not what it seems. Gang, MacroEdge.net, Ozone. Get your 2-week free subscription. Give it a shot. We have to sit there and start paying attention to the small details that are not being promoted, listened to, or even watched by the mainstream. If you start breaking down the data, the inflation data, the unemployment data, the housing data, and start putting it all together in one big sum, that's what we're trying at MacroEdge. MacroEdge.net is your last call for some sanity when analyzing everything that's going on. Subscribe today. Give it a 2-week free trial, and let me know how it works out for you. Next week, we will have a very special guest. We're going to discuss retail and restaurants. And, I got somebody requesting to get in there, and where are they? Weimar wants to jump in. Jump in, Weimar. Come on in, sir. Can you hear me, Mr. Weimar?
Oh, hey. Yeah, sorry, it's on a bit of a lag.
That's okay. It's part of our great modern internet in America.
Yeah. They put all the people listening are actually on a lag relative to the speakers. I forget what it is. I think it's like a 4 or 5 second lag. So
Absolutely.
You have this catch up. But yeah, I actually wanted to post something in the Nest. It broke pretty recently. And I just retweeted it. I don't know. It's actually not getting much traction. I probably used a word that's being downplayed right now by the Twitter algo. But I'll post it up in the Nest. Goldman Sachs and Ballast, handed back 82 apartment buildings to the lender, which was Royal Bank of Canada in San Francisco. This is a $688 million loan, so it's massive. And the story just came out today. And, you're starting to see tons and tons of stress appear in multifamily. Obviously, we've all seen building after building default in the office space of commercial real estate, but multifamily now is really starting to hurt. You saw New York Community Bank yesterday again with some bad numbers. A lot of that pertains to what's going on with rent stabilized multifamily in New York. But this is a national issue, and it's due to overbuilding. And it's very regional. It's specific to certain parts of the country right now, as with a lot of the real estate stuff. So I think single-family homes probably only seeing falling prices in the South and Southwest right now. But, here in Chicago, the Chicagoland region, they continue to go ballistic. I'm learning more and more how much of that is due to migration. We've been, the state of Illinois, the biggest recipient of migrants, particularly relative to our population. If you look at the court case filings pertaining to migration, ours are up 800%. The next nearest state is Colorado at 500%. So that's a big part of it. And I can tell you they are at open houses, and there are programs to help them buy loans. I've been going through the details all week. ITIN loans are going through the roof. That's loans for housing without Social Security numbers. And there's tons of programs to aid these people as they purchase homes. Many of them live more than one family to a home in some cases, so it's not as hard as you think to buy these. But I do understand the Chicago market is not the national market, but there is a big divergence right now in home prices in some states versus others, and I just wanted to point that out because of some of these dynamics. And I think that migration trend, if you've been reading the recent reports by groups like the Congressional Budget Office, as well as the Dallas Fed now, and there's some other people doing it. It's been much bigger than we thought. It's had a much bigger impact on consumption and the labor market than people thought. And then one other thing I wanted to point out on the labor market, I could probably I'll post the whole story because I actually have it, but it's only on Bloomberg Terminal right now because it's from Bloomberg Economics, but they've been doing yeoman's work with figuring out what's going on with last year's employment data. And it looks like it was overstated by at least a third is what they're finding given the updates from the Business Dynamics survey that's conducted quarterly. They just did the fourth quarter of 2023. And it's looking like they probably overstated jobs by at least 700,000 in the year 2023. Surely comparing the non-farm payrolls numbers to the true-ups that we're seeing, a lot of that is about the birth-death model being very, very wrong, both this year and last year. So, yeah, that's my 2 cents.
Well, Weimar, I appreciate it because the birth-death model is the roulette table of economic data, in my opinion. If you hit the right number with your chips, you make a lot of money. If you don't, God help you. I appreciate your input on this because we don't get a lot of input from the Midwest, so anytime you want to chip in and give us an update, we would appreciate it. From what we're seeing from the South, there's still a net migration of wealth occurring from your region into Florida, Texas, etc., and that should be disturbing more so than the migration from the southern border into your region.
Well, we've been having that for a long time, actually. Illinois has been one of the biggest states in terms of losers of its population for over a decade now. I think we've had net migration out of the state, pretty much going back to the great financial crisis. A lot of that does move just across the borders, though, into areas like Wisconsin and in particular Indiana. So we have this area of Chicago land called the Southwest Suburbs, and I have a lot of my family. My mom and dad are both from there originally. And so I have a lot of family in that area, and almost universally everyone has moved right across the border to Indiana because your property taxes go from around, 10 to 20,000 a year in that area to 2 to 4,000. So your property taxes absolutely fall off a cliff, and I'm talking like single family homes here. Famously, I think it was in 2015 or 16, Dwayne Wade had a house in a place called South Holland, Illinois, and the property taxes alone would cover the full cost of the house after about 6 years. I think he was paying like $50,000 a year on a $300,000 house at the time in South Holland, Illinois. So yeah, property taxes in Illinois are insane, particularly in the Chicagoland area, but particularly in the south suburbs. And it gets worse. There's kind of a ratchet effect as more people leave. The fixed cost burden of the local government and the schools gets shifted onto the remaining people. So that's why areas like the south suburbs near the border of Indiana, where it's very easy to leave and work across the border, have happened. They've just hemorrhaged people, and it's the worst in the border areas of the state. Wisconsin, to a lesser degree, along Lake County, similar thing. If you can live in Wisconsin, you just move right over the border. So yeah, I mean, it's been an issue, and a lot of them do. You speak correctly, go south, but that's not. It's not the older people particularly. We tend to stick around. I mean, I'm in my mid-30s, so I don't have any impetus to move right now. I'm fine where I'm at. I don't pay a ton of property taxes. But young people, almost all my friends, growing up, high school, college, I would say 80 or 90% of them are out of state. They're in places like Texas, Florida, Tennessee, Idaho. Those kind of places. That's where almost everyone goes.
Well, I appreciate that because you have been discussing, and you and I have interactions all the time on FinTwit. And folks, when we say FinTwit, that's financial Twitter, if you're not aware. We have these discussions, interactions, et cetera. And one of the things I've noticed is we're both noticing a problem with credit. And I don't want to go into too much detail with you on that, except to say, do you feel over the coming months that not just housing credit issues are going to emerge, but I'm seeing automotive, personal credit, now that we have the largest delinquency rate in history, believe it or not, shocking, right? Is this going to have an impact on how the banks provide credit to lower and middle class consumers?
So on credit, I actually shared something up in the Nest. It's been very interesting. One thing people need to keep in mind is this. I used to work at Discover for about 10 years. So I was in Treasury there, but I did a lot of economic research at the very end. So my last 3 years, I put together all the decks for like ALCO and stuff, and a lot of the board decks and investor decks and stuff like that. So we did a lot of economic research. I did recession forecasting for them too, and I actually did call a recession in 2020, not because of COVID or that, but just the data in 2019 was all pointing to a recession in 2020. But that's neither here nor there. But my point is simply that I understand consumer credit fairly well, because we did card, we did personal loans, we did student loans, private student loans. We were one of two large issuers, I should say, of private label student loans in the banking world at the time, because every other bank had left it. So, those are some of the products we were in. We also did home equity loans, which, so they were kind of scaling that up at the time when I left. But the auto was the one thing I didn't do. And because, Discover wasn't in that space. I even did home loans when I first got there, because we used to, do home loan lending, like single family 1 to 4 home loan mortgage lending. But they got out of that business. But yeah, so I posted it up in the Nest. You had Capital One come out, and I just wanted to highlight that the second quarter is always a benign quarter from a credit perspective. You have to keep in mind a lot of this is a deterministic function of when loan growth occurs. And it's deterministic because if you have a big bolus of growth in one quarter, which you typically do in card lending, and it's the fourth quarter, right before the holidays, as well as there's a lot of midsummer spending as well that occurs as people, go on vacations in the summer, they travel, they have barbecues, they celebrate a lot of holidays from Memorial Day to 4th of July. And then obviously there's a lot of travel in August. It's kind of notorious. So a lot of spending happens in those two periods. Most of it's actually, though, in the fourth quarter around the holidays. And with delinquencies and charge-offs, they're driven by periods of time of non-payment, basically. So 90 days after, or 30 days after you miss a payment, you go delinquent, and then 180 days after you've been delinquent, you have a charge-off, right? So you could see if you have big periods of loan growth, you're going to have, and they all occur at the same time every year, you're going to have periodicity with your credit, your consumer credit. So I point that out because a lot of people are kind of exuberant that in the second quarter, certain credit lenders are seeing improvements in their credit that had gotten very bad. Like Capital One, for instance, had seen their charge-off rate, and actually last month it went up, and it shouldn't have. If you looked at it for the last 9 years, or for 9 years from 2011 to 2019, which is a very normal, 2012 to 2019, which is a very normal credit period. Typically those would fall back, but the only thing that fell back for them was their delinquencies, and it was actually a seasonally expected fallback in delinquencies for Capital One. But their charge-offs went much, much higher, and in fact hit the highest since 2011. And also that month, they started to see a resurgence in both delinquencies and charge-offs in their auto book. And that's continued for the month they just recently reported, such that their charge-off rate, or their DQ rate, delinquency rate on autos has risen to 5.67 from 5.40 in the previous month. And COs went to 2.08% from 1.69. So these are big upticks in auto. And like I said, that's not my specialty, but those they had gone up and they had moderated. It looked like they had done something. They actually, I know this for a fact because they announced it several quarters ago in their earnings. They pulled back on auto lending. Well, it's growing again. And so is their delinquency and charge-off rate. And a lot of the bank lenders had pulled back from auto lending. Truist had, Capital One had, as I mentioned, several others as well. And they publicly announced this. But the space is starting to see an awful lot of stress. And I do know a lot of people who work in auto lending and banking, and I can tell you I don't want to say off the record, but there's a lot of issues happening there. And I did a post today about what some of those are specifically. A lot of the auto lending that's gone on happened at a period when prices were pretty inflated. In addition to that, the terms of a lot of these loans were very long, which results in smaller paydowns than you would normally expect. So, for instance, if it was a 5-year loan and they went delinquent after a year, you could assume 1/5 of it paid off. But if it's a 7-year loan, it's going to be like 13% or something along that line, 18%, I think. Or no, it'd be about 14 or 15%. But so you're actually going to get a lower pay down when they actually default. So that's another issue. The inflated valuations are another issue. And then there's the fact that a lot of people were using them to drive Uber, Lyft, Grubhub, all these other services. And they didn't actually do what they were supposed to do, which is get a commercial loan. So there's a lot more wear and tear on the vehicles that the lenders weren't expecting. And then on top of it, the repo costs are very, very high, higher than they expected when they made the loan. So a lot of these are resulting in much, much lower recoveries. Now, a recovery is different than the charge-off or delinquency.
Right.
So, I don't want to wax too poetic, but, basically, when these are going bad, they are being charged off and they try to get them back or, repo them. They're getting much less than you would expect as a recovery. So the impetus of these lenders is to try to work out any kind of deal they can to avoid that whole process because they're going to get so little. So
that's 110% because I can verify that with the auction houses. They're seeing a decline of anywhere from 10 to 30% on offers for repoed vehicles. So you're 1,000% correct on this.
Yeah, so there is a huge consumer credit problem brewing, and it's very demographically localized. Like, I'm not talking about the baby boomers who are driving consumption or defaulting on vehicles. No, it's Gen Z, it's younger millennials. That's what
Gen Z, younger millennials, and part of Gen X, believe it or not, who lost their jobs in tech. Weimar, thanks for pitching in, and always feel free to join us at 4 o'clock. Next week, we're going to focus on retail and restaurants with a special guest. Guys, girls, this has been a fantastic show. This is why you need to go to MacroEdge.net, subscribe, check out the Ozone, check out the dashboard, read the articles on our Substack, which, God, I hope we replace Substack soon, and we can sit there and expand your mind. Remember, the people who contribute to this show are worth a follow on X/Twitter. I still like Twitter better. Sorry, Elon. And also focus on what is happening behind the numbers. That's why we're here. That's why MacroEdge.net will have your back. For MacroEdge Radio number 16, this is John Galt speaking. It's happy hour. Good night now.